Great. I think let's get started. So thanks again, everyone, for joining us today for this webinar. Today, we're going to talk about generating high returns in a low interest rate environment. And for that reason, we have invited two great panelists for the webinar today. So joining us today is Sanjay, who is founder and CIO of Silverdale. Silverdale is a fund management company founded 20 years ago, managing over 1 billion in assets across more than 10 funds. So thank you, Sanjay, very much for joining us today. And then also joining us is Vivek Mohindra, who is one of our co-founders and responsible officer here at Kristal.AI. As I'm quickly going to cover like the webinar structure. So basically, you have the opportunity to ask all the questions you have on your mind. So please use the Q&A tool for this. If you have any other remaining questions, please reach out to your relationship manager here at Kristal.AI. Or if you don't have one yet, you can also at any time send an email to support@Kristal.AI. For your information, this webinar is being recorded and we will post it later. No, we will not post it, but we'll send it out for everyone. So just in case you want to revisit something or share it, we will send it out later on. So with that, I want to hand over to Vivek, because as I'm aware, not all of our visitors or attendees tonight are already Kristal users and clients. So could you give us a very, very quick overview of what Kristal.AI is doing? And start off the webinar for us tonight.
Sure. Thanks a lot for that, Barbara. I can see that our audience is raring to go, because I've already got like 4 or 5 questions even before we started. So I'm just hold on. Don't worry. Sanjay will cover everything. I'll say just a couple of points about Kristal.AI. So we are a fintech company. We are a startup. We started about 4 years ago. So we're purely digital. So it's quite good to be in this environment where people are working remotely. So we are used to working remotely. We are in 3 different countries, and like a true fintech, more than half our employees are coding friendly. They can code themselves, including our founders. And basically we offer whatever typical new technology company offers, which is transparency, access on your mobile, access any point of time, and of course use all the various financial theories, allocation of assets, and so we provide a lot of education, training, etc. So what I'm going to do is just kind of show you the platform for a brief while. So that you're you're familiar with it, and also you can kind of like browse through it and play with it while you're listening to us speak. If you get a little bored, because I know people do tend to like do other things. So don't do anything else. Just look at our website and look at our webinar. So you can go there, and there's various products there. We have ETFs, ETF baskets, stocks, and then there are funds. Within funds, we have a variety of funds, because what we believe is that it's very important to have an allocation methodology, i.e. diversification is very important, and there's Silverdale there. So you don't put all your eggs in one basket, and then for each segment that you want to invest in, we try to give you the best option available there. And that's why we've kind of got Silverdale today, because in that category of funds or category of asset allocation, they're about the best. We also do both retail as well as professional investors. So this particular presentation is focused primarily on professional investors. So because obviously it's you can see it's a high risk offering, and for retail investors, of course, we have 20,000 retail investors. Those are pretty much self-service. For them, we ask you to look at more ETFs kind of instruments, and of course we have bond or fixed income ETF. So if you're watching, you can listen to what Sanjay has to say, and then you can probably make an allocation into kind of a ETF offering. So you're very lucky. We are both bond traders actually. So Sanjay is a bond trader from the fund side, and I used to be a bond trader from the bank side. So I used to work for Citibank, Merrill, and so we in the nomenclature is called like I'm sell side and he's buy side. So, but we are very different bond traders because we are both optimistic bond traders. Sanjay and I are quite optimistic about the markets, and And one of the reasons why we called him right now is because of the timing. We were planning to have a webinar, but then we moved it forward because we think it's kind of the right time to look at fixed income products. And why is that? You've already seen what's happened in terms of technology stocks, Google, Amazon, and even Tencent and Alibaba closer to home. So they've gone through the roof, and many of you may be feeling that you've kind of missed the bus there. But in fixed income markets, while there has been a rally, but we still think that there is some juice left. So it's a good time to kind of look at this and invest quickly if you're interested to do so. Also, just like 2 days ago, the Fed changed its policy stance with relation to inflation targeting. And you would have seen the impact of that in terms of a rally in gold, rally in Bitcoin, rally in some of the other assets. What they're saying is that interest rates are going to remain low for a long period of time to come in the future, which means that fixed income products such as Silverdale become quite attractive in this environment where there's very low interest rate. So that's why I think it makes sense for Silverdale to to be presenting it to you today. So what I'm going to ask him now, I'm going to move it to him. I'm going to ask him to cover a little bit about what his investment philosophy is, because bonds are both of us being bond traders, it's quite a complicated asset class. There are thousands and thousands of bonds out there. How do you choose the right one? That becomes very, very critical for performance. So I'll leave it to you, Sanjay. I'm going to pass over and stop my screen share. So all the best. I can't hear you, Sanjay.
Yeah, you're mute.
Yeah, can you remove your mute?
Yeah. So thank you very much, Barbara and Vivek, for the kind introduction. It's always a pleasure to address my investors, potential investors, and fellow investors. It's a privilege to be able to talk to you today. And as usual, I like to make it more interactive. So please do continue to send in your questions. And after a very brief presentation, we would take to the questions of there. And just to tick the box, here's a disclaimer, which I'm sure you will read in deep details and deliberate and think about it. For me, let me go on to the presentation. So as many of you are familiar, Silverdale Bond Fund, we have delivered roughly about 8 to 9% return per annum for almost 10 years. We are in a very conservative investment asset, which is basically into IG. Typically, we are 75% IG plus minus 5%. This is very important to keep in mind, because when you compare us with other funds, they would typically be 60 to 65% IG. So on an average, we are typically 10% more conservative than typical investment grade bonds one we see on the street. We're extremely well diversified, 100 plus bonds, of course, 122 to be precise. We are low duration of roughly about 1.8 years now. We had gone as low as 1.3, slightly up now. We still believe maximum juice is in the lower end of it in terms of risk adjusted basis. I'm sure many of you have heard me earlier and are aware that on a long-term basis, our leveraged bond portfolio delivers to you superior returns than even equities. And I'm talking about record over 135 years, and time permitting, you'll happy to deliberate more after my brief presentation. The one thing unique about our fund is that we pay you $2.10 per share per quarter, which is $8.40 per annum. So you know exactly amount, $2.10. You know the exact date, which is the first Monday of each calendar quarter. This is fantastic from the investor point of view, because they have a definitiveness in terms of cash inflow. And when we manage billions of dollars, for me to manage cash flow is not a big deal. It's more than adequately covered by the bond coupons itself. So this is very unique again of our fund, that we pay you $2.10 dividend per quarter. The unique thing of our fund is that the leverage is taken by the fund house and not by you. Right? So that by no stretch of imagination whatsoever can you ever get a margin call. Now this is critically important, and Until about a year ago, people were using, oh, Sanjay, I know it's okay, good to have. But after the March, April this year, people have appreciated the real benefit of having a ring-fenced leverage. And for our fellow Singaporeans, it's like our good old properties where you take the property on a mortgage and not required to service the mortgage loan. So you're getting enhanced return because of leverage, but you are not responsible for the leverage. And that's something which earlier was restricted to large sovereign fund insurance companies, etc. We have brought down to level of retail investors, those who can take advantage of that. And as we pointed earlier, given where the interest rates are, it's no-brainer that at below 1% cost of funding, they can enhance your returns significantly without adding to your risk in the commensurate manner. The other interesting thing is that typically when people talk about leverage funds, they're talking about lock-ins, typically in terms of fixed maturity plans out there. You locked in for 3 years, 5 years, or what it might be. However, in our case, our fund is a weekly fund. So you can come any week, you can go any week. There is no restriction, no limitation whatsoever. Not only that, we are very unique in the world in terms of our fact sheet, which is of course available on Kristal platform also, which is that we tell you every week what we are doing. So typically in the case of fund houses, you get a monthly report which talks about big picture, what happened in Americas, what happened in Hong Kong, etc. out there. Here we tell you exactly what we did, which gives a huge amount of comfort to our investors. And that's the reason why our attrition rate is less than 5%, which means less than 5% of investors who have invested in our fund have ever left our fund almost last 10 years. Again, showing a quality of course, you, the investors, and of course, consistency of our returns. The other very interesting portion is in terms of risk management. And I'm sure Vivek is going to grill me more on that. We shall talk about it in details as we go further. But just to give two takeaways to you. Number one, and very importantly, specifically more important because we are in the fixed income space, is the fact that we have a track record of having 0 defaults. Over 10 years of running this fund, we didn't have a single default in our portfolio. That shows the quality of our portfolio, that shows the quality of the investment team which manages your portfolio. And also, we never got a margin call, right from including in the COVID short time. So takeaway to you is we're talking about investment grade bond portfolio, which has a YTM of close to about 11%. So high quality, we're talking about 72% IG, all rated by S&P, Moody's, Fitch, and not internal ratings. We're talking about a well-diversified portfolio, 122 bonds over 26 countries. Highest allocation to bond being 2.88%, and well-diversified geographically and sectorally also. Again, to summarize, investment grade short duration bond fund with the leverage YTM of 11% per annum for 1.8 years. That gives you the overview of the fund. So Vivek was mentioning in terms of the, where is the juice in the market? He was referred to the FOMO people have with the Googles and Baba. And what I want to highlight to you is that coming to fixed income space, whenever there is a financial rout, the returns you get is higher than the losses. Typically, you get 140 to 225% return in terms of from where we started from. And I'll give color to you. So if you were to look into 2008-2009 financial crisis, where we saw the IG bond tumbling by 5%, the bounce back was 19%. The high yield, which fell by about 35%, the bounce back was 81%. However, even if you were to take an average, don't take a median, whatever you can look at it. In terms of COVID-19, where we saw the IG falling by almost 8%, the bounce back is likely to be close to 11%. And the high yield, which fell by 20% or we should look at bounce back of 45%. Now, of course, about 2/3 of the returns is already been achieved. Right? It's very important to keep this in mind. So when there is a financial route, you get 140 to 225% return, and most of the return comes in about 9 months. This is as per JP Morgan. Right? We believe at Silverdale that this time it will come in almost 6 months. Right? So almost 2/3 returns have come, but the good news is 1/3 return has to yet come. Right? So still there is juice in the market. Do we give exact numbers to you? So typically, for example, in case of IG bonds, typically spread we talk is about 121 bips, sorry. And at the peak, it touched about 350 bips. Today is about 131, still higher than the pre-COVID era. So we still have a gap to cover. And in case of high yield, of course, gap is still higher. Right? And for people, those who are technically inclined, the way to look across is this. The yield you are getting into IG is indicating a default rate of close to about 11%. Right? To give you historically, for the period 1981 to 2018, the default for IG bond were close to 0.9%, less than 1%. Right? Even at the time of Great Depression, 1930-33, the worst time the humanity has seen, the default rate was 1.6%. Right? So even if you were to be more charitable in the sense that the default rate is 2%, then please remember the return you're getting is 3 to 5 times higher than you should be getting across out there. And please appreciate, I'm talking about the global IG space, predominantly or US IG, right? Come to Asia, and this 131 which you see actually is 178, which is crazily high. So we have lots of juice in the market in terms of IGs into Asian IG space. And of course, you want more questions, we're happy to go more details in the geographies, etc. out there. In terms of high yield, again, like we're talking about a spread of 354, which implies a default rate of close to about 35%. Right? And highest ever has been 15%. Again, about 3 times higher return you're getting as compared to the risk you're taking. And it's not difficult to understand this. See, I can give you, of course, technical reasons in terms of spread, etc. But from even layman point of view, it's very straightforward. It's basically the backstop given by the Fed. Is the fact that the actual default rates actually are coming down. So this is what is projected by the rating agencies, and this is where the default rates are. And the reason, very simple, is simply because companies are able to raise funds. Right? If Boeing raises $25 billion of fundraising, it is, we know for certain, Boeing is not getting bankrupt in the next 18 months. Right? If Gap raises $2 billion, we know even if one single t-shirt of Gap is not sold, Gap is still safe for the next couple of years. Right? And that's exactly what the Fed wants. Fed doesn't want companies to go bankrupt. Right? Same thing we are seeing in Singapore, the way the government is supporting our companies in Singapore, right? So the key takeaway to you is that the actual defaults which will happen because of COVID would be much lower than the implied defaults given by the spread. Only one caveat, remember, when we talk about default, we talk about default of our universe, the typically, $5 to $50 billion market cap companies which issue US dollar bonds in which we invest. I'm not denying the fact that there is a lot of hardship to the humanity as totality. The mom and pop stores would suffer, but good, bad, ugly, the truth is this: when the small man dies, the market share goes to the big boys, right? So from that point of view, there's a lot of juice in the market. And before I hand over again to Vivek, one last point, which is that in terms of timing wise, we still see timing is perfect timing, because typically credit markets bottom 6 months before the GDP bottoming out. So if you think that the surprise element of COVID, the problem of COVID is over or shall get over in next 6 months, we believe that the bottom of the credit market has already been achieved. On to you, Vivek.
Yeah, Sanjay, yeah, actually, we've got quite a few questions already. Now, the questions are in terms of, EM versus developed market, how will the EM market do, and how will the, in the COVID, and will there be a differentiation and all. But, I think from whatever I've spoken to you so far, I think you are a very bottoms up analysis. You look at very individual companies. You don't really care about the macro, what's happening in emerging market and developed market and so on and so forth, but you're more interested in the individual companies and all that. So yeah, because, I can see some 3-4 questions. Will EM struggle? Will EM debt to GDP ratios are too much? But I think, can you just take us through your the way you look at it, and it's very company specific, and how that helps, because ultimately the bond investor, we get like 5-6% yield, but if you default, you lose 60-70%, right? So that's why bond investors are always so scared. So that will also help answer this question which we have from James Chia about how you look at this, whether it's macro down or bottoms up.
No, very good question. As a matter of fact, I'm very glad that we have smart, investors with us, because that's a key question to ask. Because in case of fixed income, our upside is always capped to the par value. Nobody's going to pay me more than the par value of the bond. So you're absolutely right. So the most important thing in case of investing into bond is the risk of default, right? Which is exactly highlighted by you. So when does the company default? The company defaults when the company gets bankrupt. When does the company get bankrupt? The companies get bankrupt when they don't have cash to pay. They have nothing to do with the profit of the company, right? Otherwise, Google would have died, Uber would never exist, right? So profit is not as important as the cash flow, specifically for the bonds. So our core competency is the fact that we are rare fund managers in the world, those who invest into IG bond, yet have a fungible cash flow model. Right? So I explain this to you in very simplistic terms this way. Let's think of a company which is a holding company in London, which is a subsidiary in Indonesia or India. They may or may not be able to assess those cash. However, when you do consolidation of books of account and the US GAAP or IFRS, you would take the liabilities of the subsco, add to the liabilities of the holdco, and come with the consolidated liability. And by definition, you will take the cash of subsidiary, add to the cash of parent to come with the mythical figure called consolidated cash. So our core competency is the fact that we try to determine the real cash the company has. And that's the beauty of it, is that once the cash in the company goes up, it's a question of time, the cash will translate into net profit, which will translate into better financial ratios, which will translate into higher credit rating or a buyback. Typically, 15 to 20% of our portfolio gets a credit upgrade or a buyback every year. That shows that our real fungible cash flow model really works, right? Because this all added alpha to the portfolio. And something which I'm always proud that nobody really appreciate as much, and now people do, which is that it also helps us to avoid the defaults. So when we see the cash in the company coming down, we can run away from it before the company defaults. And that's been proven more importantly in times of volatility sector there, when these quality of the assets matter a lot. So the takeaway to you is that in terms of our process, we are more focused in terms of bottoms up. So because of the fact that we have a proprietary cash flow model based on fungible cashes. Of course, in terms of risk, we do have very sophisticated risk measures. We are looking into almost 50 parameters on each bond, and then following them on a real-time basis to make sure that the quality of the portfolio is very robust. In terms of your question that where we see juice, as I mentioned to you earlier, we see more juice in the emerging market and specifically in terms of Asian emerging markets. So Asia is where we see a lot of juice being there. Let me see if I can get you something to give you the color of juice.
One more question that has come in is about the performance with the rest of the market also. Because on our website the performance is like over a period, 1 year period of time, which includes the COVID. So there's a negative during the COVID. So if you can just cover in terms of the performance versus the rest of the company, that's one of the questions that we're trying to answer. Yeah.
Sure. So this gives you color in terms of what sort of spreads and pickups we are seeing in terms of Asia versus the rest of the world across of that. Again, something similar to the point which I mentioned earlier, that there is still a lot of juice in the market, which we mentioned here. So 178 versus 131. And in terms of the performance and how does it translate into performance, which is a very, very question you're asking. So pre-COVID, we have given you about 8% per annum for last almost 8 years, right? And as compared to index, which gave you what 4% return, which is almost twice the return that of Bloomberg emerging market US dollar corporate index 1 to 3 years. And post-COVID, we have given you roughly about 24% absolute return, not annualized, since April 23rd till date. During this period, of course, Bloomberg index gave you about 4% return. The key reason for, of course, this outperformance is the fact that because we have a bias towards emerging markets, at the peak of the COVID shock of March and April, what happened was that this segment of the bonds, there were very less buyers for it. As a result of which, the price was much more depressed on the screen than actually it was in the market, because the trading volume had fallen very sharply. And therefore it felt to be much lower. So as the panic gave way to flight to safety, we saw a huge bounce back happening in our fund. So to give you a month by month performance, so typically, as you know, most funds give about 52 to 58% positive months. Our track record is about 2/3 of the fund months. So 2/3 of the months we given you positive return, and of course when we give positive, we give higher. This is we get a net positive returns. And also, if you look in terms of year-on-year return, anybody who has invested into the fund for more than a year and a half, 2 years, has always made money in the fund. Right? For example, someone who came in say 2015 and exited in 2018, you made 36% return, right? So and so forth. These are the month by month returns, and as expected, of course, we did have a drawdown in the month of March and April, but more importantly, we adequately and more covered across in the subsequent months. The important thing from the investor point of view is that what is the outlook going forward, right? So what happened is fantastic, 24% and beautiful, Sanjay, what next? And the answer to that is that even today, when we talk about our YTM, the yield of the portfolio, we have almost 11.5%, right? It's about, it is a quarterly slide you're seeing. The more important thing from the retail investor point of view is to keep in mind that we have always maintained our dividend. So the $2.10 you are getting every quarter, you continue to get it, including in the first and the second quarter this year.
Yeah, there's another question specifically on that. Like, is it that you're paying the dividend from out of capital, or is it purely from from the coupons received on the bond holdings?
Vivek, it's basically the cash flow is another issue for us. You know, we are very, very conservative in the way we work a sector out there. So the bonds which we hold on an average give us a coupon of roughly about 5%, right? We are levered about 1.2 times, 1.2, 1.3 on that level. So basically it means that I get 5 into 2.2, one principal, 1.2 is being leveraged, 5 into 2.2, namely 11%. Okay. Against 11% inflow from the bonds alone, cash flow which are getting from coupons, I'm paying you close to 8%, less than 8%. So it's fantastic.
Yeah, no, I agree, and that's a very valid point. But also, you mentioned something like that there haven't been any margin calls and no defaults in your entire 10-year history. Can you just cover the process on how you maintain and make sure that the leverage remains within a limit, or it's how do you manage that kind of a track record? Because I mean, I know in the market that especially with a lot of private banks where people were holding bond holdings, there were a whole bunch of margin calls that came into people. What's the strategy there?
Wonderful. I think that's again on the very important things for people to understand. So the reason why we didn't get a margin call is multiple. At the core of it is the fact that we always keep unutilized credit limit of roughly about 10%. Okay, this is my leverage, and I've noticed it actually has come down over a period of time, and lately it has been pretty fetish in terms of where we are today. So first is that if the bank is happy to give me say 70% loan to value, I'll draw down only 60%. So always have 10% as unutilized credit limits, which will be there for me. The second thing is that if you look in terms of my duration, my duration is 1.8 years, but more importantly, is a clean duration. It's not a long short duration, or it's not a barbell where I mix a 30-year bond with a 30 days bond, make a portfolio which makes no sense. Here, if you notice, we have almost 62% of the portfolio maturing in 0 to 2 years. Importantly, we have 1/3 of the portfolio maturing in 1 year. So if you have a portfolio wherein you have 10% headroom, 34% maturing in 1 year, namely 44%, and underlying coupon being 5%, roughly 50% of the portfolio is a current asset maturing in 1 year. Of course, there is never a margin call on the cash you hold, right? It's because the cash which you hold. And that's the reason why we never get a margin call. It's not to deny the fact that we have sophisticated risk management tools which help us to continuously realign the portfolios to make sure that we have the even lower volatility.
Right. Some of the other questions which we are getting, and that this probably we should have a discussion between the two of us, is about the macroeconomic environment. What do you think of inflation, how the COVID thing is going to play out, and so on and so forth, and also. So that's some of the things I'm mentioning, and maybe you can add a couple of points, and then I'll kind of give my views also on how the kind of environment is panning out on a macro basis in terms of the COVID, in terms of the trade dispute, and in terms of overall growth of the large economies.
Okay, so let's divide it into a few slices. First and foremost is that in terms of the big macro picture, the world GDP is coming down, and of course we don't see anything dramatic changing in next months. In fact, this impact of COVID would be felt for at least for next 10 years. Just to remind you, 2008 crisis took or more than 10 years. So for COVID impact would be more than 10 years. But the more important thing is that given the impact the COVID has been having, and here I want to share this slide with you to give you color to what I'm talking about. Here it is. So in terms of the outlook wise, so we would see a bounce back happening in terms of GDP. But for China, the rest of the world, we will see a bit of drag happening. Now, what does it imply from the investor point of view? Right? That's more important. So rather than giving the customer. So from the investor point of view, remember that whenever there is a financial rout or of such a massive scale, there would be, unfortunately, and I've said unfortunately very humbly, transfer of wealth from the poor to the rich, from the weak to the stronger, from small companies to bigger companies. Bigger companies become bigger. They will have more market share. They have muscles to get into new fields and survive. So a lot of things will happen. So from the investor point of view, one has to make a distinction between what is a human tragedy in terms of COVID and the implication medically, and what it implies from the investment point of view. So so in terms of the immediate short term, we know China is doing well and Chinese trade will continue to do very well. In the immediate short term, we don't see a threat to US dollar being the world's reserve currency. But at the same time, we also know that US dollar is in the last legs of being the reserve currency, and over next about 14 to 17 years, as the McKinsey, it would no more be the largest reserve currency, and partly thanks to companies like you, because the fintech is going to bring a lot of blockchain sector into place and remove all the advantages people used to have with the base currencies and reserve currencies sector out there. Coming down to other thing is the volatility. The volatility will increase again sporadically as we get the news sector out there in the market, and also for the fact that today there is a certain amount of overconfidence in the capital markets because of the Fed backstopping. And once people realize that the company's profit is not as good as they should be, minus the largest company will still gain to gain, but I'm talking balance of the companies, you will see a readjustment happening in the equities market, and wherein again it will be safer for them to be in the bond market. So from that point of view, again, bond market makes sense, and specifically given that we don't expect the interest rate to rise anytime too soon, it will leverage bond fund will make a lot of sense. Touching upon the other point, you talk about inflation. People have a wrong notion that just printing money would give inflation. If that was true, after 2008, we should have seen a wild inflation. We didn't see inflation. Why? Because while the amount of money going in terms of printing of dollars went in the market, the velocity of money came down. Right? Today, the velocity of money has come to pathetic levels, right? Where people are taking money from the bank and making good of the expenditure they need to do. Right? Government is sending money to them. The money is being used for consumption. So the circulation of money actually come down. So we don't expect the demand suddenly to shoot up, and therefore the inflation shoot up in the short period of time. Yeah. It's a long topic, but I thought that was giving you.
Yeah, no, definitely. I mean, I think, if you look at the markets, you can definitely see the, discrimination between the, the selected or the healthy sectors versus the unhealthy sectors, like you pointed out, from the small to the big, from the poor to the rich. And, that discrimination is happening quite, it's not necessary. I mean, I don't agree with it, but that's the reality of the whole situation. And also emerging markets over some of the developed markets. There's also, kind of a diversification there. Some of the emerging markets have suffered, but if you look at China coming out so strongly, and also some of the other Asian economies will probably recover quickly and, do better in terms of their credit matrices as compared to what's happening in US. The Fed is backstopping for a particular reason. And that's benefited the US company, but you should understand that the US dollar is all pervasive. So a rising tide lifts all boats, and the US dollar pumping by the Fed has actually benefited high yield markets in China and high yield markets in Asia also. So it's and also some of the emerging market equity markets. So that's the other thing. So you mentioned about issuance, but I would also mention about rising stock prices. A company which has a very high market capitalization is not going to default. So even if it doesn't have, doesn't have the cash flows, but if it has an ability to issue shares at the current valuation, and you can see even the, Indian Nifty or all of them are at new highs. So they won't default if they have access to capital markets. So that's the other point I would like to add. Let me just kind of look at some of the questions. There's a question on trade tensions, but I think again, some of these things relating to trade tension, COVID, are going to be there for the next 5 to 10 years. I don't think this is going to go away in any time in the near future. How did your AUM perform over the whole year? If you can give some color on that. There's a question on that.
Very good question. As the AUM is concerned, our AUM is up. We got net inflows up there. And let me clarify this to you, two things there. Number one is that, yes, we are not an exception. Most of the funds with a good track record have done pretty well. So this chart, for example, gives you color there. So this is slightly old. So we have about $120 billion which have gone in terms of the various IG funds, and about $53 billion which have gone to high yield funds. This is over and about $135 billion which has gone to very specialist funds. Having said that, coming to specific numbers, so if you look in terms of our AUM, we were close to about 200 million net assets, about 700 million in terms of gross assets before the COVID, and today we are almost the same level, give or take 5-10 million up and down. And also I mentioned to you earlier, So the good news is that our investors appreciate our conservative way of managing things, and therefore they're very happy as long as they're getting dividend, and they know after paying dividend also they're getting 30-40% over last 10 years, perfectly fine with them. So we don't see any issue whatsoever. Rather, what we feel that over next 18 months, we think we should be able to double up our AUMs.
So final words now. I think we're coming to the close. Anything we want to summarize about your fund, and then I will summarize a little bit about Kristal before we close.
Sure. So let me summarize what I've spoken till now, so that all of us on the same page. So basically, we are talking about a Silverdale bond fund, which is typically given you by 8 to 10% return per annum. We have a track record of having 0 defaults since the fund house was established. The leverage taken by the fund house and not by the investors, so there's no risk for margin call onto you whatsoever. We never get a margin call, among other things, is because of the fact that we keep 5 to 10% headroom with us always. We high quality fund, typically 75% plus minus 5%. Low duration, so lower duration, lower the volatility, much better. You can foresee the future. We're talking about close to 1.8 years. Extremely well diversified. We're talking about 122 bonds across the board, and maximum exposure, which we limit, is to 3%. To be honest with you, actually it's 2.5%. So when you see more than 2.5%, it's purely because of the appreciation of the bonds. So which is slightly good news, but yes, if it goes above 3%, we will aggressively book profits out there. And we take no non-USD exposure. Again, very important, because if you were to compare with some other bond funds, they take huge amount of local currency risk. And we believe, look, if you want to take a currency risk, better buy a currency fund. If you're buying a bond fund, you should take only credit risk. That's the reason why we stick only to US dollar. As I mentioned to you, we pay $8.40 as the dividend per year, which gives you a consistency of cash flow, which will come to you on a definitive date, which helps you to plan your investment or expenditure as you might. This year, I'm talking about the first 2 quarters, we got about 9 upgrades, again in line with about 15 to 20% of our portfolio. We get an upgrade every year because of our superior risk management and superior ability to understand the companies, namely the fungible cash flow model. So takeaway to you, we're talking about an investment grade short duration US dollar bond fund with a YTM of close to about 11% per annum for next 1.8 years.
Okay, thank you very much, Sanjay. So I will, I will just take you back to my the portal we have. So for example, like I said, as I mentioned, so we are a digital platform, and we make all the information, etc., available to you, through our portal, mobile app, etc. It's free to use. A lot of information, of course, as he mentioned, the bond fund itself, all the data. You can open the latest fact sheet. This is the 30th July one, and you can get information about this, even their holdings, etc., etc. Yeah, this is the holding, and as he mentioned, they provide a lot of color about what they're doing. Let me just yeah, you see, in terms of the latest appreciation for the last month, what was good, what was bad, etc., etc. So you can kind of look at that. Besides that, you can also look at many other funds, etc. On our platform. For those of you who are retail investors, as I mentioned, we have also ETFs across all asset classes, and we can give you a portfolio based on that. So for retail investors, there's a robo-advisory element to it. So it will basically give you advice without even talking to a human being, and that's done really, really well in the last, during this crisis. Like I said, our assets have been growing consistently the whole year, and as you know that things are moving from the traditional non-technologically innovative companies to the more innovative companies. So fortunately, we fall into that category, and so there's people, we see people using it on almost a daily basis in terms of our advice on various allocations, etc. With that, I think we come to the end.
Vivek,
yeah.
Wait, let me answer this question because the second time the person has put the question. The question they're asking is in terms of allocation pre and post COVID in terms of the high yield.
Okay. So
let me confirm to you that pre-COVID, pre-March, our allocation to high yield was roughly about 24-ish%, 23, 24%. Today is about 27, 28%. And the increase by 3-4% is purely because of the fact that in last couple of months, we have seen the high yield doing extremely well. And to take away for you is that we would be keeping roughly about 75% into IG, and we have no intention to drift from a strategy. A couple of percentage up and down point is what you see. And as a risk measurement, we would hardly ever drift much more there. Even if it's juicy, we will try to contain it because we think that 8 to 10% on a consistent basis for 10 years is a fairly good return with a risk level of such a low risk which we'd like to take.
Okay, thanks, Sanjay. So we end on that positive note. Oh yeah, there is okay. That's an automatic pop-up that comes onto the screen. Barbara, yeah, back to you. I think yeah, the housekeeping.
I think thank you so much, both Sanjay and Vivek, for taking the time tonight, and thank you everyone who joined us as an attendee. If you have any questions left regarding Silverdale or regarding Kristal, just send us an email, support@Kristal.AI, and thank you so much and have a good evening.
Good evening. Thank you. Bye-bye.